Welcome to Tesla Deep Dives. The pivotal topic on our agenda today is the $425 question, deconstructing the Morgan Stanley downgrade and what it signals for high-growth stock valuation. B-roll, rapid-fire montage, a fast car, an electric charging station, a humanoid robot arm, a stock chart plunging 3.4%. Welcome to the deep dive. The market is asking a 425 question, and the answer signals a dangerous inflection point for every high-growth stock on the board. The company is Tesla, and the firm that has been its biggest cheerleader, Morgan Stanley, just downgraded it to equal weight. B-roll. Full-screen graphic comparing TSLA PE of 210x versus S&P 500 average and a legacy automaker PE. This is a soft landing call, but the numbers are loud. The firm raised its price target to $425 from $410, but with the stock trading near $440, it functionally implies zero upside. The core issue: Tesla trades at a jaw-dropping 210 times forward projected earnings, second only to one other stock in the entire S&P 500. This downgrade is the institutional world saying the valuation has now fully priced in the future. B-roll. Drone shot of the Gigafactory/production line, followed by an animation of the Optimus robot. The bull case, as Morgan Stanley's own model confirms, is not dead. It's just accounted for. Tesla is not being valued as a car company, but as an artificial intelligence and robotics platform. The firm estimates Tesla's massive potential in its software and network, valuing the nascent Optimus humanoid robot program alone at an estimated $60 per share. This is the AI multiple at work, paying for the company's ambition to solve full self-driving and dominate embodied AI. B-roll. Graphic. Optimistic scenario arrow up to $860 with text FSD/Robotaxi scale. The most optimistic layout articulated in the report projects shares could rise by nearly 90% to $860. This outcome is entirely dependent on Tesla navigating the current EV downturn, scaling its robotaxi fleet successfully, and achieving a ChatGPT moment with FSD in 2026. If they execute the long-term vision, the premium is justified. B-roll. Split screen, slow-moving EV traffic on one side, a chart showing falling auto margins on the other. Now for the skeptic's view. You can't pay 2030 robotaxi prices for 2025 car margins. Morgan Stanley cut its 2026 EV sales estimate, forecasting North American volume could decline by around 12% next year, aligning with a broader industry slowdown. The core auto business faces brutal margin pressure from competition, and the stock's stretched enterprise value to EBITDA multiples are nearing 48 times on the firm's in-house model. B-roll. Animation of a timeline slipping graphic. 2026 fades to 2027 plus, followed by a visual of regulatory documents/stamps. The second bear argument focuses squarely on execution and regulatory hurdles. The valuation is priced for perfection, yet the timeline for key catalysts, specifically the launch and regulatory approval of the robotaxi/cybercab, is a black box. A slip in this timeline, pushing autonomy into 2027 or beyond, could cause the market to violently re-rate the stock from an AI multiple to a mere hardware multiple. B-roll. Graphic. Pessimistic scenario arrow down to $145 with text competition/margin pressure. The downgrade signals a thematic shift from growth at any price to show me the revenue. If the robotaxi narrative fails to materialize quickly and the company succumbs to competition, the downside alternative scenario sees the stock potentially plumbing the 145 mark, a loss of over 70% from current levels. B-roll. A clear visual of a crossroads sign with two paths, auto manufacturer versus AI platform. The $425 question is a psychological turning point for the market. It marks the moment when the firm that invented the high premium valuation for Tesla says the promise is now fully priced in. The new reality is a choppy trading environment through 2026 as investors demand concrete execution to justify the enormous valuation premium over traditional tech and auto players. B-roll, a dashboard graphic with 3 key metrics/gauges: operating margin, robotaxi launch date, and FSD adoption rate. What should investors monitor? 2 metrics are crucial. 1. Operating margins for the core auto business, which recently slipped toward a 5-year low of 5.8%. And 2. Any tangible progress on the robotaxi/cybercab regulatory and development timeline. This battle between the dream and the math is now set. We score the probability of the bullish thesis scaling successfully at a cautious 610. The ultimate question is not if the technology works, but if the valuation can survive the regulatory reality. That's the core of the Tesla Deep Dive. Let me know your thoughts in the comments. Please like, subscribe, and hit the notification bell. Your engagement fuels our critical research.